Hello, everyone, and welcome back to the Financial Freedom Show. If you're new here, I like to talk about personal finance, investing, and how to make your money work for you. In today's video, we're going to dive into the Schwab US Large Cap Growth ETF, commonly known as SCHG. We'll cover what SCHG is, how it works, its performance, and whether it might be a good addition to your investment portfolio. So without further ado, let's get started. First things first, what exactly is SCHG? SCHG stands for the Schwab US Large Cap Growth ETF. It's an exchange-traded fund managed by Charles Schwab and a leading investment management company. SCHG aims to track the performance of the Dow Jones US Large Cap Growth Total Stock Market Index, which includes large US companies with growth characteristics. The primary goal of SCHG is to provide investors with exposure to a diversified portfolio of large cap growth stocks. These companies are typically known for their above average growth potential and include well-known names like Apple, Amazon, and Microsoft. Now let's talk about how SCHG works. When you invest in SCHG, you're buying shares of an ETF that holds a diversified portfolio of large cap growth stocks. The fund's holdings are weighted based on market capitalization, meaning that the larger companies have a bigger impact on the fund's performance. Sectors represented in SCHG include technology, consumer discretionary, healthcare, and more. This diversification within the growth sector helps spread risk, as you're not reliant on the performance of a single company or subsector. SCHG is passively managed, which means it aims to replicate the performance of the underlying index rather than trying to outperform it. This passive management strategy often results in lower fees compared to actively managed funds. Let's take a look at SCHG's performance. Historically, large cap growth stocks have some of the best performing assets in the market. SCHG has benefited from this trend, delivering strong returns to its investors. However, it's important to remember that past performance is not indicative of future results. One of the advantages of investing in SCHG is its low expense ratio. The expense ratio for SCHG is currently around 0.04%, which is incredibly low compared to many other ETFs. This means that more of your money is working for you rather than being eaten up by fees. Additionally, SCHG's low turnover ratio can result in lower transaction costs and tax efficiency. This makes it an attractive investment for long-term investors looking to minimize costs. Now let's discuss the benefits of investing in SCHG. One of the main advantages is the exposure to large cap growth stocks, which are known for their potential to generate high returns. By holding a large range of these stocks, you're spreading your risk out across multiple companies and sectors. Another benefit is the growth potential of the companies within SCHG. Many of these companies are leaders in innovation and have a strong competitive advantage, which can lead to significant growth opportunities. SCHG offers liquidity as well as flexibility. As an ETF, it can be bought and sold throughout the trading day, providing investors with the ability to react to market movements and adjust their positions as needed. Lastly, the low expense ratio and tax efficiency of SCHG make it a cost-effective choice for investors. Keeping costs low is crucial for maximizing your long-term returns. While SCHG has many benefits, it's also important to consider the potential risks. Growth stocks can be volatile, and their prices can experience significant price swings based on market conditions and company performance. Another consideration is the concentration risk. Although SCHG is diversified within the large cap growth sector, it's still heavily focused on these types of companies. If the growth sector as a whole experiences a downturn, SCHG's performance will likely be negatively affected. Lastly, while the low expense ratio is a benefit, it's also important to remember that all investments come with some level of cost. Be sure to consider your total cost of your investment, including any brokerage fees or potential taxes. So is SCHG the right investment for you? It really depends on your financial goals, risk tolerance, and investment strategy. If you're looking for exposure to large cap growth stocks and are comfortable with the associated risks, SCHG can be a great addition to your portfolio. SCHG is especially suitable for investors who believe the long-term growth potential of large cap companies and want a low-cost, diversified way to invest in them. However, if you're seeking for a more balanced approach, you might want to consider combining SCHG with other sector or broad market ETFs. In conclusion, the Schwab US Large Cap Growth ETF, or SCHG, offers a compelling way to invest in large cap growth stocks. With its low expense ratio, diversification, and growth potential, it can be a valuable addition to many investment portfolios. Here's a few final tips. Always consider your risk tolerance and investment goals before choosing an investment. Make sure to diversify your portfolio to balance risk and return. Keep an eye on the performance of your investments and make adjustments as needed. And take advantage of the low costs and flexibility offered by ETFs like SCHG. If you found this video helpful, please be sure to give it a thumbs up and don't forget to subscribe for more personal finance and investing tips. Leave a comment down below if you have any questions or if there's a specific topic you'd like me to cover in a future video. Thanks for watching, and I'll see you in the next one.